Welcome to the Deep Dive. We're your shortcut, really, to understanding those complex financial reports that land every quarter.
Yeah, cutting through the noise.
Exactly. Today, we are jumping into Lennar Corporation's latest numbers, Q2 2025. And it's a really interesting picture of how a major home builder is, let's say, navigating some choppy waters in the housing market right now. Our goal here, our mission for this deep dive is simple. Cut through the jargon, slice through the numbers, and pull out what really matters for you. We want to uncover what's actually going on, on the ground.
Right. And it's so important to remember these reports. They aren't just spreadsheets. They tell a story. A story about the market, how companies like Lennar are reacting, their strategies, and what they see coming down the pike. And what we'll see today is this fascinating contrast. Lower earnings, definitely, but surprisingly more activity, more volume.
Okay, let's unpack that right away, that contrast. Because the headline earnings number, well, it grabs your attention. Net earnings for Lennar in Q2 were $477 million. That's 1.81 cents a share.
Which sounds okay until you compare it.
Exactly.
Yeah.
Compare that to Q2 last year, 2024. They pulled in $954 million. So it's a pretty significant drop. And even if you take out those mark-to-market losses from their tech investments, earnings were still down. Clearly, profitability took a hit.
No question.
But then here's the other side of the coin you mentioned, the volume. While earnings are down, new orders were actually up 6%, over 22,600 homes.
Yes, solid increase.
And deliveries also nudged up 2%, just over 20,100 homes compared to last year. So less profit, but more homes ordered and delivered. How does that square with a soft market?
Well, that's the tension, isn't it? Stuart Miller, Lennar's executive chairman, he basically said it outright. The softness comes from affordability challenges and a decline in consumer confidence.
Right.
So what you're seeing isn't Lennar struggling to find buyers necessarily. It looks more like a strategic choice. They decided to push volume, keep the machine running, even if it means lower profit per home right now. These trends, lower earnings but higher volume, they point to a company saying, okay, market share and activity are paramount now. We'll accept thinner margins to keep building and selling. It's about the long game.
So if they're pushing volume like that, something's got to give, right?
Right.
That volume probably comes at a price, literally.
Yeah.
What happened with the average sales price?
You nailed it. The average sales price for the homes they delivered, it dropped down to $389,000 in Q2 this year from $426,000 last year.
Wow, okay.
And again, management was clear why. Stuart Miller said they drove volume with starts while incentivizing sales to enable affordability. They're using discounts, incentive, whatever it takes really, to help buyers overcome those affordability hurdles, higher rates, shaky confidence.
So a deliberate strategy to lower the price point to keep things moving.
Exactly. It's a trade-off. They're choosing volume over maintaining that higher average selling price from last year.
And that price drop, well, you'd expect that to hit the profit margins pretty hard.
Oh, absolutely. Gross margin on home sales fell to 17.8% this quarter. Compare that to 22.6% a year ago. That's a big squeeze.
Yeah, almost 5 percentage points.
Right. And it's usually a mix of things. They flagged higher land costs compared to last year and obviously lower revenue per square foot because of the price adjustments. They did mention getting some savings on construction costs, which helped offset it a bit. Shows they're fighting on that front too. But yeah, maintaining profitability is tough when you're actively lowering prices.
Okay, so prices are down, margins are down. You'd think they'd be laser focused on making everything else run smoother, finding savings internally, right? What did you see on the operational side? Any signs of efficiency gains?
Definitely. That's where John Jaffa, the co-CEO and president, comes in. He highlighted some pretty significant improvements, actually.
Like what?
Cycle time, how long it takes to build a home. They cut that by 12%, down to 132 days this quarter.
Okay, faster builds.
Faster builds, yeah. And their inventory turn, how quickly they sell through their inventory, that improved too. Up to 1.8 times from 1.6 times last year. It's not glamorous stuff maybe, but it's critical.
Especially now.
Especially now. It all ties into what they call their production-first focus and their even flow operating model. They're trying to make the whole process smoother, more predictable.
And wasn't there something about their land strategy too?
Yes, the asset-light land strategy. They control almost all their home sites, 98%, but own very few outright, like 0.1 year supply of owned lots. This keeps a lot of capital off the balance sheet and makes them more flexible.
So less risk tied up in land.
Less risk, more flexibility. The idea is all these operational shifts build long-term efficiencies that should help margins recover eventually, even if the market stays soft.
Right. And what about SG&A? Selling, general, and administrative costs, did those go down with the efficiency drive?
Interesting point. Actually, SG&A as a percentage of home revenue went up slightly, 8.8% versus 7.5% last year.
Oh, that seems counterintuitive.
It does at first glance, but Lennar frames it as further investment and engagement in future efficiencies. So the argument is they're spending a bit more now on systems or processes to enable bigger savings down the road, investing in that even flow model.
Okay, spending money to save money later. Makes sense. So that's the core home building story. But Lennar does more than just build houses, right? What about their other divisions? Financial services, for example.
Yeah, good question. Financial services actually had a better quarter. Operating earnings were up to $157 million from $146 million last year,
How come?
mostly higher profit per locked loan. What's fascinating here is how this segment can be a buffer. Even when home sales margins are pressured, the financing side can still perform well, maybe even better in some conditions. They capture more value from each buyer they serve.
A nice internal hedge almost.
Sort of, yeah. It provides some stability.
Okay. What about the other segments? Multifamily and Lennar Other.
Multifamily, their apartment building arm, saw its operating loss shrink a bit, down from $20 million last year to $15 million this quarter. So, slight improvement there.
But Lennar Other.
That one went the other way. The operating loss there got significantly worse, jumped to $53 million from $28 million a year ago.
Ouch. Why the big jump?
Primarily, those mark-to-market losses on their technology investments we mentioned earlier.
Tech bets.
Exactly.
Yeah.
Investments in companies like Blend Labs, Hippo, Open Door, Smart Rent, Sonova, prop tech stuff mostly.
Right.
And if you connect this to the bigger picture, well, it just shows the volatility that comes with these kinds of investments. They might have huge potential long-term, but in the short term, their value can swing wildly and impact reported earnings. It's quite a contrast to the, bricks and mortar stability of building houses.
Yeah, different kind of risk profile entirely. So despite the market headwinds and that tech investment volatility, Lennar keeps stressing its balance sheet strength. They mentioned $5.4 billion in total liquidity, $1.2 billion in cash just in the home building segment. That sounds pretty solid.
It is solid. Liquidity is definitely a strength and crucial in times like these. But there's always context, right?
Always. What's the context here?
Well, their home building debt to total capital ratio did tick up. It went from 7.7% at the end of Q2 last year to 11.0% this quarter.
Okay, so taking on a bit more leverage relative to their capital base.
A bit more, yeah. They also issued $700 million in new senior notes during the quarter, mostly to pay off older debt coming due. And they bought back $517 million worth of their own stock.
So managing debt, returning cash to shareholders?
Exactly. It shows they're actively managing their capital structure. They feel strong enough to do buybacks, even with the market softness, but they are also watching their debt levels. It's that balancing act again.
We've talked national trends, but home building is so regional, isn't it?
Yeah.
Did the report show much variation across the country?
Oh, absolutely. You see big differences. Average sales prices, for instance. In the West, the average home delivered was over $600,000. But in the South Central region, it was way down at $244,000.
Huge difference.
Huge. And while prices were generally down everywhere compared to last year, some regions saw massive jumps in new orders. That South Central region, for example. Orders were up nearly 30%, over 6,600 homes compared to about 5,200 last year.
So they're really leaning into affordability where it makes sense, driving volume in those lower price markets.
Looks like it. Adapting the strategy market by market.
And one thing that caught my eye was the backlog.
Yeah.
The number of homes sold but not yet delivered. That seems to be shrinking.
Yeah, it is. Down to about 15,500 homes worth $6.5 billion. Last year's closer to 18,000 homes worth $8.2 billion.
What does a shrinking backlog typically signal? Less certainty about future revenue.
Generally, yes. It means there's less revenue already booked for future quarters. It puts more pressure on maintaining that strong current sales pace to keep the delivery pipeline full.
Ties back to that even flow model, needing constant input.
Exactly. They're operating leaner, faster, turning inventory quickly rather than relying on a huge backlog built up over time. It requires consistent execution.
Okay, so given all that, what are they telling us to expect next quarter? What's the guidance for Q3 2025?
Well, the guidance pretty much confirms the strategy we've been discussing. They expect both new orders and deliveries to be roughly similar to Q2, somewhere between 22,000 and 23,000 homes for each.
Okay, maintaining the volume pace.
Right. And the average sales price, they see it ticking down again slightly. Guidance is $380,000 to $385,000.
Still prioritizing affordability then.
Seems so. Gross margin, they expect it to hold steady around 18%, same as Q2. So they think they can maintain that level for now.
In the SG&A, that investment in efficiency.
They expect that to pay off a bit. Guidance is for SG&A to be lower as a percentage of revenue, around 8.0% to 8.2%.
Okay, some improvement there. And financial services.
Expected to continue performing well. Guidance is $175 million to $180 million in operating earnings, which would be another sequential increase.
So the Q3 outlook reinforces the current playbook. Keep volume steady, even if prices dip slightly, hold the line on gross margins, get some SG&A savings, and rely on financial services for solid contribution.
That sums it up perfectly. It's a clear plan to navigate what they see as a continued soft, affordability-challenged market. They're managing the controllables.
All right, let's try and wrap up this deep dive on Lennar's Q2. The big picture seems to be a company grappling with a softer housing market, mainly due to affordability issues and maybe some shaky consumer confidence.
Yep, and that's hitting their bottom line, lower earnings, lower gross margins per home.
But, and this is the key contrast, they aren't just sitting back. They're actively pushing volume, using incentives, accepting lower average prices, and really focusing hard on operational efficiency.
Right, and getting results there. More orders, more deliveries than last year, faster build times, quicker inventory turns.
They seem to be making very deliberate choices.
Absolutely. And that strong balance sheet, despite the small uptick in debt ratio, gives them the foundation, the buffer to execute this strategy in these conditions, even with the swings from those tech investments adding some noise.
So here's something to chew on as we finish. Lennar is consciously trading price for volume, betting on efficiency to make it work. What does that mean for the rest of the housing market? If a giant like Lennar is doing this, will others follow? Could this put more downward pressure on new home prices overall? And what does it tell you about the fundamental trade-offs builders face today between price, volume, and profit? What stands out most to you about Lennar's strategy right now?